Boldly put, economic indicators are the compass that guides every savvy investor through the tumultuous seas of investment decisions. Picture a world where we can peek into the future of economies, anticipate market movements, and adjust our strategies accordingly. That's the power of economic indicators. They're not just numbers or percentages on a chart, they are the pulse of an economy's health and the heartbeat of business cycles. Economic indicators provide insights into consumer buying power, production activity, and overall economic performance. They help us gauge systematic risks that can impact industries and companies, shaping the landscape of future trends. Key indicators such as the gross domestic product, interest rates, consumer price index, and others work like a lighthouse, guiding investors through the fog of market uncertainties. Whether you're a seasoned investor or just dipping your toes into the investment waters, understanding these indicators can be the difference between a profitable investment and a costly mistake. First on our list is the gross domestic product, or GDP, the heartbeat of an economy. The gross domestic product, or GDP, is essentially the total value of all goods and services produced within a country in a given period. It's like the economic scorecard, summing up the monetary value of all finished goods and services made within a country's borders in a specific time frame. So, why is it called the heartbeat of an economy? Well, think of it like this. When your heart beats faster, it's usually because you're doing something active, right? The same goes for an economy. When GDP growth is strong, the economy is in an active, healthy state. It's producing more, selling more, and generally doing well. On the other hand, when the GDP growth is slow or negative, it's a sign that the economy is in a sluggish state or even contracting. This can be due to a number of factors like decreased consumer spending, lower investment, or unfavorable trade balances. Investors, both big and small, pay close attention to GDP data. Why? Because it provides a broad overview of a country's economic health. It shows whether the economy is growing or shrinking and at what pace. Based on this, investors can anticipate market trends. If the GDP is growing, it usually means businesses are doing well, which can lead to higher stock prices. Conversely, a shrinking GDP could suggest a downturn in the market, prompting investors to adjust their strategies accordingly. And it's not just about domestic investors. International investors also keep a close watch on a country's GDP. A strong GDP growth can attract foreign investors, bringing in more capital, which further stimulates economic growth. But remember, while GDP is a crucial economic indicator, it's not the be-all and end-all. It's one part of a larger economic puzzle. Investors should always look at other economic indicators and market factors to make informed decisions. A robust GDP growth signifies a thriving economy, a beacon for investors looking for profitable opportunities. Next up, we have interest rates, the price tag on borrowed money. Interest rates, in the simplest of terms, are the cost of borrowing money. Picture it as a rental fee where the lender is compensated for parting with their money for a period of time. It's a powerful tool that central banks use to control inflation and stimulate economic growth. But why should investors care about interest rates? Well, let's delve into that. Interest rates have a significant impact on investment decisions. A rise in interest rates means borrowing money becomes more expensive. This can slow down consumer spending and corporate borrowing, leading to a dip in company profits. On the flip side, a drop in interest rates makes borrowing cheaper, potentially fueling economic activity and boosting corporate profits. Consider sectors like real estate, manufacturing, and services. They are heavily reliant on borrowed funds. Changes in interest rates can dramatically affect these sectors. Let's start with real estate. When interest rates rise, mortgage costs increase, making homes less affordable. This can lead to a slowdown in the real estate market. Conversely, when interest rates drop, mortgage costs decrease, potentially sparking a boom in the real estate sector. Moving on to the manufacturing sector. This sector often requires significant capital investment. High interest rates can make these investments more costly, potentially slowing down production. On the other hand, lower interest rates can make these investments more affordable, potentially spurring growth in the manufacturing sector. Lastly, we have the services sector. Many service-based businesses rely on borrowed funds for expansion and operations. Higher interest rates can increase their cost of doing business, whereas lower interest rates can boost their profitability. The takeaway here is simple. Interest rates are a key driver of economic activity. They can influence the performance of various sectors and, consequently, the returns on your investments. In the world of investing, understanding the impact of interest rates is crucial. It's about knowing when to ride the wave and when to stay ashore. Interest rates are like the tide, they can either float your investment boat or sink it. Enter the Consumer Price Index, or CPI, your personal inflation barometer. Now you might be wondering, what exactly is the CPI? In simple terms, it's a tool that measures the average change over time in the prices paid by urban consumers for a basket of consumer goods and services. It's like taking the economic temperature, but instead of measuring degrees, we're measuring the rate of inflation. So why should you, as an investor, care about the CPI? Well, the CPI gives us a snapshot of the purchasing power of consumers. When the CPI rises, it means prices are increasing and each dollar you and I have buys a smaller percentage of a good or service. This is what we call inflation. On the flip side, if the CPI falls, it means prices are decreasing and we're in a period of deflation. In this scenario, each dollar you and I have can buy a larger percentage of a good or service. For investors, changes in the CPI can be a double-edged sword. On one hand, rising prices could mean higher revenues for companies, potentially leading to increased stock prices. On the other hand, if inflation gets too hot, it could trigger a rise in interest rates, which could hurt companies that rely heavily on borrowing. In a nutshell, the CPI is a crucial tool for investors because it provides insights into economic trends. It helps you understand the potential impact of inflation on your investments and allows you to make informed decisions about where to put your money. Remember, inflation doesn't just affect the price of milk or bread. It can erode the purchasing power of your investments, and that's why understanding and monitoring the CPI is so important. Inflation can erode your investment returns, making the CPI an essential tool in your investment arsenal. Now let's spotlight employment indicators, the watchdogs of the workforce. Employment indicators are the guardians of the labor market. They're like a barometer, measuring the pressure and temperature of the job market. They tell us how many people are working, how many are looking for work, and how many have given up the job hunt entirely. But why do they matter so much? Well, employment indicators are a crucial piece of the economic puzzle. They provide insights into consumer spending potential. The more people working, the more money being earned, and consequently, the more money being spent. This spending stimulates businesses, driving economic growth. Let's touch on some key employment indicators. The unemployment rate is the percentage of the labor force that is jobless and actively seeking employment. A low unemployment rate suggests a tight labor market, often leading to wage inflation as businesses compete for scarce workers. Then there's the labor force participation rate, which measures the proportion of the working-age population that is either employed or actively looking for work. A high rate is generally a positive sign, indicating that a large proportion of the population is contributing to economic productivity. The Job Openings and Labor Turnover Survey, or JOLTS, gives us a snapshot of job vacancies, hires, and separations. High job openings signal high demand for labor, which can lead to wage increases and boost consumer spending. Non-farm payrolls is another key indicator. It measures the change in the number of people employed during the previous month, excluding the farming industry. A strong increase in non-farm payrolls can suggest strong business confidence and economic growth. And finally, we have the average hourly earnings, which measure wage inflation. Rising wages can lead to higher consumer spending but can also signal potential inflationary pressures. As an investor, keeping an eye on these indicators can give you a sense of the economic trajectory. If employment indicators are strong, it often signals a robust economy, which could lead to higher corporate earnings and potentially higher stock prices. Strong employment indicators often signal a healthy economy, a promising sign for investors. Lastly, we have the balance of trade, the tally of a nation's buying and selling game. It's the difference between the value of a country's imports and exports over a certain period. If a country exports more than it imports, it has a trade surplus. But if it imports more than it exports, it's in a trade deficit. Think of it as a country's ledger, keeping track of its economic transactions with the rest of the world. It's akin to a nation's profit and loss statement, providing a snapshot of its trading performance. So why does the balance of trade matter? It's a significant economic indicator that can significantly influence a country's currency value. A trade surplus tends to appreciate the currency, making it stronger, while a trade deficit can lead to depreciation, making the currency weaker. And here's where it becomes interesting for investors. A strong currency can make a country's assets more attractive to foreign investors, potentially driving up investment. On the other hand, a weak currency can make the country's exports cheaper, potentially boosting its manufacturing and export sectors. So, the balance of trade can significantly sway investment decisions. It can influence where investors put their money, whether in stocks, bonds, or commodities. It can help investors identify industries that may benefit from a country's trade dynamics. For instance, a trade surplus in a country rich in natural resources might indicate a booming mining industry. On the other hand, a trade deficit in a country with a robust manufacturing sector might signal opportunities in export-oriented industries. But remember, just like any other economic indicator, the balance of trade is just one piece of the puzzle. It needs to be considered in the context of other indicators and broader economic conditions. The balance of trade can hint at future economic trends, a valuable insight for any investor. In the world of investment, economic indicators are your compass, guiding you towards profitable decisions. They are not just numbers or percentages, they are the pulse and rhythm of our economy, providing critical insights into its health and direction. Let's quickly recap what we've learned. The gross domestic product is the heartbeat of an economy, indicating its overall performance. It's like the heart rate monitor of a patient, giving us a clear picture of the economic health of a nation. Interest rates, on the other hand, are the cost of money. They are like the weather forecast for investors, helping us understand the financial climate and plan our investments accordingly. The Consumer Price Index is our inflation barometer. It measures the average change in prices over time that consumers pay for a basket of goods and services. It's like a thermometer measuring the economic temperature and alerting us to any signs of inflation. Employment indicators are our workforce watchdogs. They keep an eye on job creation and unemployment rates, which are vital signs of economic health. They're like the body's reflexes responding to changes in the economy. And finally, the balance of trade is our trade tally. It gives us a snapshot of a country's imported and exported goods and services. It's like a scoreboard, keeping track of a nation's economic wins and losses on the global stage. Each of these indicators plays a pivotal role in making informed investment decisions. They are the tools that can help you navigate the complex seas of investment, providing you with a clear direction and helping you avoid potential pitfalls. Remember, a well-informed investor is a successful investor. So, equip yourself with the knowledge of economic indicators and steer your investments towards success. If you found this information useful, you know what to do. You've just unlocked the secrets of key economic indicators. But this is just the tip of the iceberg. There's a vast wealth of knowledge waiting for you. All you have to do is click that like button. It's a small gesture, but it makes a world of difference. It tells us that we're on the right track and encourages us to produce more content that can guide you on your investment journey. And while you're at it, why not hit that subscribe button too? It's your ticket to a world of insights. With each video, you'll gain a deeper understanding of the complex world of investing, empowering you to make informed decisions that can shape your future. You'll be part of a community of like-minded individuals, all eager to learn, grow, and succeed. So, are you ready to take your investing knowledge to the next level? Then make that commitment. Like the video, subscribe to the channel. It's your first step towards becoming a more informed and successful investor. Don't forget to like and subscribe for more insights that will empower your investment journey. Thank you for watching.